Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is the special edition to understand the key highlights from the RBI's monetary policy review meeting that has just been underway. RBI Governor Shaktikanta has made the announcements. It's a status quo policy, which means that the RBI and the MPC have kept the repo rate unchanged at 6.5%, and this is for the 9th consecutive time that we've seen a status quo policy. A majority of 4:2 by the MPC has taken this decision to keep the repo rate unchanged at 6.5%. They've also decided to retain the withdrawal of accommodation stance. They've also said that there are significant challenges to medium to long term growth that one needs to keep an eye out on. Remember, both on the growth projections and on the inflation projections for FY25, there is no change. However, there are minor tweaks in the quarterly updates, which I will detail for you in just a bit. Let's welcome on board our top guest today to decode for us what has been said by the RBI Governor. Ms. Achula Jethmalani, the economist at RBL Bank, is joining right in. Warm welcome to you, ma'am, and thank you so much for taking the time out. Well, first up, did you notice any change at all in the key things that the RBI Governor has really said, or is it an absolute status quo policy?
No, it's an absolute status quo policy. It has been quite consistent in its commentary as well, with the same reiterations that the focus remains on achieving the 4% inflation target on a durable basis, the withdrawal of accommodation stance as well. So the policy is quite consistent in its nature.
Right. Now, Achula, do help us understand, as far as the inflation projections are concerned, that's something that caught my attention. I'm sure you are also looking at it with a keen lens right there. The inflation forecast for FY25, that's been retained at 4.5%. But there have been tweaks. In Q2, that has been revised from 3.8 to 4.4%. For Q3, from 4.6% to 4.7%. Although for Q4, it's slightly reduced from 4.5% to 4.3%. So, averaging this out, do you think that 4.5% will be able to be retained is something that I want to know.
Yes, I am still to look at the quarterly revisions in the press release, if that's the case, that the quarterly numbers have undergone a change. But yes, there is, if the numbers have been revised from 3.8% for second quarter to 4.4%, then of course there is some bit of concern on the inflation front. And also, over the last, from the previous policy to this policy, we have seen some developments such as the telecom tariff hikes.
Yes.
Food inflation has been quite persistent in nature, which probably has transpired into MPC's inflation forecast if the numbers have been tweaked on the higher side. Because we've seen that there's a lot of persistence in food prices driven by vegetables, which is why we saw the previous print also come in at 5.1%. versus the expectations that it could probably slip below the 5% handle and start gradually moving towards 4.5% kind of run rate.
Absolutely. Now let's discuss on the growth for projections as well. That's been retained at 7.2% with risks evenly balanced. But again, the Q1, there has been a moderation, which the governor did say that this is due to the updated information on certain high frequency indicators. Now, what would this indicate going forward from here as far as both a higher inflation uptick in some of the quarters and a moderation in growth in Q1? How should one be reading this?
Yes, there's about a 15 to 20 basis points downward revision in the first quarter numbers. And it can also be attributed to a slow progress in Kharif, showing that we have seen some of the lead indicators, such as PMI, are definitely in the positive, but the momentum, sequential momentum from the previous quarter has been slightly slower, and which is what probably got baked into the quarterly numbers of the RBI as well. Having said that, if we look at the other quarters, from second quarter to fourth quarter, the growth trajectory has been, forecast has been retained around 7.2 to 7.3%. And the RBI's estimate for growth stands at 7.2% on average for FY25. We are still holding on to our growth forecast of 7% for FY25. So we don't see a significant slowdown in India's growth trajectory, at least at this juncture. But nonetheless, by the time get to the October policy, we'll have a little more clarity on how India's monsoon would take shape and what can we be looking at in terms of agri output and also the industrial output going forward, given that we are getting into a slightly jittery phase of a global growth moderation, so to speak. So I think we will be reviewing the numbers in about a quarter's time probably. But as of now, the 7 to 7.2% handle looks fairly achievable for FY25,
7
which
to
is why
7.2%. Yes, yes. Please go ahead. Huh.
which is why I suppose the focus on inflation and price stability was reiterated at this policy. Because as of now, the concern of food inflation still running almost at 9% kind of run rate is a bit concerning. Although one may say that it is due to certain commodities such as vegetables or cereals, but it is quite persistent in nature. And as the RBI governor stated, they do not want it to seep into higher wages or cost push inflation, and therefore they would rather want to be in a wait and watch approach, and therefore cautious policy pause is how we read this policy.
Cautious policy pause is how you read this. So we are going to be taking that as your word right there. In fact, the inflation point that you're highlighting, the MPC the governor also highlighted that the MPC cannot afford to look through persistently high food inflation as it may spill over. So that is a key risk that the RBI governor and the MPC have been consistently looking at this point in time. So inflation projections, how would you really look at yourself with these latest tweaks within the quarters coming in? Would you also look at some tweaks going forward?
No, as a matter of fact, we are still holding on to our inflation forecast of 4.5 to 4.55% for FY25 because we expect components such as fuel inflation and core inflation to be much softer from what they were in the previous year. Food inflation, we are still expecting it to be at around 7% for all of FY25, and which is why the pace of disinflation to get to the 4% target is getting obstructed. But 4.5 to 4.6% kind of inflation for FY25 is something that we think is achievable. And in fact, in the next 3 months, if food prices were to correct, then we could even see a positive surprise on the inflation front.
Okay, there could be some positive surprise, so leaving room for that as well. But clearly, like you also pointed out and like the governor did highlight, this is the first time in many months and years that the tariff hikes on mobiles has been mentioned in the policy, as well as a key watch, as that could be leading to some pressure on the core inflation and the headline inflation as well. So that is again a key monitorable going forward, because I want to understand from you, a lot of commentary from telecom analysts has consistently been that we will just have to see whether the consistent tariff hikes continue going forward from here, and this hike was probably just the beginning of what could be in the offing, and there could be multiple hikes as well. So is that a key risk that remains to be monitored by the RBI for the rest of the meetings for this year?
Yes, also depends on the frequency of tariff hikes that we could be possibly seeing. If this is a tariff hike which is going to last for about 9 to 12 months, then we may not see that kind of an upside risk to inflation forecast per se. As of now, we're still thinking that the core inflation would be in the 3.5% to 4% kind of handle. It's much softer on an average. For the first quarter, it's just about 3.1%. So it really depends on the magnitude of tariff hikes we would be seeing. A bit of tariff hikes are already getting reflected in your CPI numbers. We saw it in the last 2 months on a sequential basis. The price uptick has gotten factored in, and it remains to be seen how much of that will get reflected in the July print, so to speak. As of now, we are factoring in estimating a CPI inflation target of level of about 3.4% for the July reading, as we expect some bit of comfort come through from fuel component and also core inflation staying around the 3.5% kind of handle.
Right. The other important bit, Ms. Jethmalani, I wanted to understand from you is the absence of clear hint of any rate cycle reversal. That still seems to be missing despite a lot happening over the last 2 weeks on a global front as well. There was a changed narrative with respect to the US Fed and how that would be moving towards the rate cuts. It was an earlier expectation of just a 25 basis point cut, and later on, with the kind of scenarios emerging with the unemployment data, the recessionary concerns coming back to the fore, it was the narrative is being built that the US Fed could probably be looking at a 100 basis points cut. So did you find any missing link from the RBI governor's speech as far as those risks are concerned, and therefore what could be a reaction of the RBI on the domestic rate cut front?
That's a very interesting question because this time we've not seen any policy pivot or signal to policy pivot by the RBI MPC. As I mentioned, since the policy is largely on expected lines, both in terms of overall inflation and growth forecasts, the liquidity management approach that the governor highlighted in his press statement, wherein they stated that they will remain nimble and flexible on managing liquidity. So overall, since the policy is broadly in line with our expectations, we are reviewing it as a cautious pause policy and not really a hawkish one. And a policy pivot is not something that we were looking out for in this policy because we knew that the MPC will be going into its policy decision making with some of these global developments, which still remain very uncertain, very fresh. And the domestic factors such as inflation and food inflation that we already touched upon, more clarity on food disinflation by the time we reach October. So I think those inputs are still pretty critical domestic factor wise, and which is why the MPC in a 4:2 vote has probably taken a cautious approach or a wait and watch approach rather than a signal that we are getting closer to the 4% target and therefore a monetary policy accommodation. So I believe that still would play out in second half of FY25. So October to December policies, we could see some positive signaling coming from the RBI MPC if the disinflation progress picks up.
Right. So, Ms. Jethmalani, in that scenario, what would your own estimates be with respect to the rate cycle reversal? Do we have to wait for much longer? By when do you expect the reversal to come in? Will it be again a slow and gradual process rather than a sudden and a bigger cut that we are expecting the US Fed to do? How do you expect the RBI to move forward?
Yes, I think global developments will definitely be key critical inputs given how the FX dynamics have played out globally and how the currency, dollar INR pair, has also remained under pressure because of these developments, despite robust fundamentals on the external sector front, foreign exchange reserves, all of that. So even if we were to get into a rate easing cycle, we are expecting that to come through only in fourth quarter of FY25.
Okay.
And a policy that is much easier in its approach by December 2024. We are already witnessing liquidity that come through in the way of liquidity management. Over the last couple of months, the banking system liquidity has remained quite favorable and in surplus. It really remains to be seen if the RBI would continue to maintain a surplus liquidity condition, which would automatically put, a downward pressure on your money market rates and therefore keep the cost of borrowing at least through one channel on the softer side, even if we don't budge or move on the policy rates front. So we are expecting the rate cut cycle to begin from fourth quarter FY25, and it is likely to be a shallow rate cut cycle.
Yeah.
It may not necessarily follow a lockstep approach of what the global central banks, especially the US Fed, might do, because I think our policy will be more determined by domestic factors and influenced by global developments, but still policy will be determined by what happens back home on inflation and growth front. And given that the Fed had hiked much more aggressively than how RBI started with its rate hike cycle, there is more room for the Fed to go on with aggressive cuts if their inflation eases and employment situation also eases, as compared to RBI MPC, wherein the rate hikes were not as significant, and therefore we would probably take a very slow and gradual approach to rate easing, and more to do with liquidity management, as I mentioned before.
Okay, got that. Well, let's just quickly take a detour to look at how the stock markets are reacting to the policy. It's been very, very volatile through the policy announcements, and even now there is a 0.6% of a decline on the Nifty. 24,149 is the current level. It's again very, very defensive. Only the pharma, the broader markets, consumer durables hold up. Banking names, only HDFC Bank is trying to pull up the Nifty or stem the losses right now within the private banking space. Some move is coming in, but the rate sensitives largely still remain subdued after the status quo policy announcement as well. Ms. Jetmalani, also to understand a bit more, with respect to, the kind of announcements that were made on the banking scenario, particularly, the banking conditions, high credit demand, lower deposits at this point in time, rising disbursals of the top-up home loans that have been noticed at this point in time as well. Lenders have been advised to take remedial actions, even though the liquidity measures are not announced, and they are looking to be nimble and flexible in the liquidity management. But how are you looking at this financial system overall? Is there any kind of a hint of risk there?
I suppose, as the governor has stated in his policy and in press releases on several occasions, what is also being observed is that due to restrictive policy approach from the past, the credit growth is starting to show signs of moderation. It also is in a way indicating that how past rate hikes have started to get reflected in those numbers. In terms of overall liquidity landscape, since the RBI has been keeping it in the positive zone or surplus zone, we are not seeing any significant push up in rates per se, and therefore overall the cost of borrowing and financial stability aspect along with price stability is auguring well for the broad financial system.
Right, and some more announcements right there that were important for the viewers to also note. I will just highlight those. On the digital lending apps, remember the RBI Governor reiterated a public repository of digital lending apps is proposed to prevent any unauthorized lending. And the other positive impact that he highlighted is that on the UPI payment limit, on the UPI tax payment limit that's been increased from 1 lakh rupees to 5 lakh rupees per transaction. That's pulled up some stocks like Paytm in action. So we'll show our viewers how Paytm has gone up to the day's high, now up 4.8% higher in trade. Another interesting announcement that came in by way of check clearing within the banking space is that continuous check clearing is proposed to be introduced, which means your checks could now be cleared in just few hours rather than taking 1 or 2 days as has been the norm. So that is a big important announcement that has been made right here. All right, Mr. Jetmalani, anything else that caught your attention within the speech that I missed out asking you?
No, you've covered it all, Sakshi. And I think the policy, apart from the monetary aspect of it, when we look at the regulatory aspect, also it is quite forward-looking that way. As you mentioned about UPI, the digitization aspect, and ensuring that there is a conducive setup in place is also a major positive. That's how we are reading the entire policy.
All right. Well, on that note, thank you so much, Ms. Jetmalani, for being with us on this very special, edition where we decoded the first few minutes and the kind of announcements that have been made by RBI Governor Shaktikanta Das, a status quo policy and all the highlights that you've indicated. Thank you so much. Truly appreciate your time with us on Business Today Television, helping us decode for all our viewers what the key announcements have been.
Thank you.
All right, viewers, we'll wrap it up at that. 24,160 right now for you. A status quo policy for the 9th time. No change in stance. A 4:2 majority taking that decision to keep the repo rate unchanged at 6.5%. FY25 growth and inflation forecasts have been maintained with tweaks in between. None of the highlights came in by way of whether the policy is looking for a pivot going forward from here or not. Nothing has been mentioned on that front. And the how Ms. Jethmalani also how Ms. Jethmalani put it as far as her understanding of the policy announcements is that she is talking about it as a cautious pause right now. No signs of dovishness or extra hawkishness that have been projected in the statements that have been given by the RBI governor right there. We'll wrap it up at that, but do stay tuned. We will come back with a detailed analysis with a full panel of economists, bankers to detail for you how the policy statements should be read in just a due course of time. And in between, you can continue to see how earnings conversations continue on our channel on Business Today Television.
When we say manufacturing is smart, does it also mean that the people who are behind that manufacturing process have